So Neil, we've talked before about the benefits of pensions, and obviously from a tax relief point of view, they can offer a very attractive way of saving for retirement. But I think it'd probably be worthwhile maybe just recapping a little bit on the detail of tax relief, and in particular how you see it benefiting your clients, because it can sometimes be complicated depending on whether somebody's employed or self-employed. So if you wouldn't mind talking us through how you see it working for your clients.
Yeah, definitely. So tax relief is given subject to the annual allowance, which is the overriding limit for tax relief on pension contributions. It is given based on the gross pension contribution at an individual's marginal tax rate. So this means broadly that anyone earning under £50,000 a year generates tax relief of 20% on pension contributions. Anyone earning between £50,000 and £125,000 a year generates tax relief of 40%. And anyone who earns over £125,000 a year generates tax relief at 45%. Now, basic rate relief is almost always given at source and paid in directly into the pension pot, but what many clients don't understand is that actually the higher and additional rate tax relief, so the additional 20 and 25%, to bring it up to 40 and 45% respectively, that needs to be claimed by the client either on the tax return or a standalone claim. So we see it from time to time with new clients that they haven't actually claimed the tax relief on their pension contributions in prior years, and the key thing to look out for is that you've only got 4 years from the year the pension contribution is made to go back and claim that relief, otherwise it's lost.
I think there is a bit of perception, isn't there, that HMRC will contact you if you're due that relief,
Yeah.
as opposed to you having to actually do anything about it.
Yeah, unfortunately it's not that simple, and the onus is very much on the individual to make that claim. So let's put the numbers together in a case study, a short case study. So let's take a fictitious client, let's call her Isabel. So she's got a salary of £90,000 per year, and she makes a pension payment into her SIT of £10,000, so a pension contribution outside of her payroll. Now, what HMRC will do is provide the basic rate tax relief at source, so they will top up that £10,000 of pension contribution to £12,500 by paying £2,500 directly into Isabel's pension fund. Now, what Isabel needs to do is either on her tax return or a standalone claim is claim the higher rate tax relief she's due because she pays tax at 40%. Now, when she does that, she will receive an extra £2,500 of tax relief. And overall, what this means is that Isabel has ended up with a pension contribution of £12,500 in her pension fund, but it's only cost her £7,500.
So it's very cost effective, isn't it, compared to other savings?
Yeah, exactly, and it sort of demonstrates the power of the tax relief and how you go from the net £7,500 paid by Isabel to £12,500 in her pension fund.
So in terms of what you've just said, Neil, obviously getting the relief, whether it be at 20 or even 45%, is very attractive. Is that the maximum level of tax relief that any individual can have if they pay into pension?
Well, there is a niche scenario, and there's an opportunity for those earning between £100 and £125, £140 to generate a higher rate of tax relief of up to 60%. Now, this is all to do with the interaction that pension contributions have with the personal allowance, which applies for income tax. So the personal allowance of £12,570 currently is the amount that you can earn tax-free in a year. Now, once your earnings exceed £100,000 in a year, for every £2 they exceed £100,000, you lose at £1 of your personal allowance. Now, this means the window of earnings between £100,000 and £125,140 are subject to a rate of tax of 60%. So whilst that is a high rate of tax, it does give the opportunity for the pension contributions to relieve that high rate of tax. So let's go back to our case study, Isabel. So let's say she's had a promotion and now she earns she did earn £90,000 a year. She now earns £120,000 a year. So she makes the same £10,000 contribution. Now, the 60% tax relief sort of comes in 3 ways. There's the basic rate tax relief of 20% that HMRC pay directly into Isabel's pension. There is the 20% claim through her tax return, as I said in the previous example, due to her paying the 40% rate. And there is 20% tax relief on the pension contribution through the recovery of her personal allowance, which no longer is tapered to the extent she makes a gross pension contribution. Now, just to summarise that again, if Isabel makes the same £10,000 contribution, she ends up with £12,500 in a pension again, but it actually only costs her £5,000 in this instance, and that's because of the 60% marginal rate of tax relief. Now, of course, once the funds are within the pension, they roll up tax-free as well, so income and gains will not be subject to tax, and this can mean that she will get a higher rate of return in the long run.
And I guess as well, when we've been working with clients, there can be times like that where people may be in that income bracket. There's an opportunity there that may not continue forever, particularly if somebody's income is likely to be increasing. So it's quite opportune for some clients, particularly if they can get that 60%, to maximise them when they can, where in the future it might not be possible.
Yeah, exactly. I mean, clients don't often react well to you telling them that they're in the 60% marginal rate of tax.
Yeah.
So this is a good opportunity to relieve that through pension contributions. So it's definitely some good planning that can be done to bring down the tax rate.
Yeah. Okay, thanks, Neil.